Good afternoon, everyone. I'm Shailendra Pandey, and I would like to warmly welcome you to today's conference call organized by PPFAS Alternate Asset Managers IFSC Private Limited. Thank you for taking the time to join us today. Today's conference will be represented by Mr. Nirmal Bari, Principal Officer, Mr. Akshay Falgunia, Fund Manager, Mr. Purvesh Pandit, Compliance Officer. We have already received quite a few questions from participants. We will take these up one by one during the session. If you would like to ask additional questions, please use the Q&A feature and we will address them live after covering the questions already received. We appreciate your interest and active participation and we look forward to a meaningful discussions. Over to you, Nirmal. Thank you.
Yeah, thanks, Shailendra. Good evening, everyone, and thank you for joining this call today. This is the first ever call that we are doing for the general investors at large for PPFAS gift. The flow of the call would be, as you already know, that we would be knowing that we have gone live with our PMS. So to start with, we'll discuss a bit about why global investing is important for anyone. Then we will talk about our PMS, and after that we'll talk about the outbound funds, and then finally the inbound fund. And after that we'll take up questions that we have received so far. So to start with, I would like to discuss a bit about Gift City. So what Gift City is and how what we are doing basically in Gift City. So it was envisaged, Gift City was envisaged on the lines of DIFC or Hong Kong, where this is a place which is physically located in India, but from a FEMA perspective, it is outside of India, which basically enables all the inflow and outflow of foreign money through this channel. So this is the only approved IFSCA so far in India, and a few years back through the IFSCA was appointed as the unified regulator for this with global benchmarking of regulations. IFSCA at present has powers of 4 Indian regulators: the RBI, SEBI, the PFRDA, as well as the IRDA. So with IFSCA coming into picture, this has now become a full-fledged financial ecosystem. It's not only about fund management. There are various other operations that are happening in Gift City. There are multiple banks that have set up operations. There are fintech companies which have come in. There's ship leasing, aircraft leasing, which has come in. For our perspective, the fund management ecosystem here now is growing at a significantly rapid pace, and with the 2025 regulation FME regulations that IFSCA came out with, there was a lot of clarity on retail funds and retail FMEs, which has enabled launching of this lower ticket size products from Gift City. So coming to what PPFAS gift is, to start with, on the PPFAS Alternate Asset Managers IFSC is a wholly owned subsidiary of Parag Parikh Financial Advisory Services Limited, which is also the parent and the sponsor entity for the for PPFAS mutual fund. Beyond this, there is also an NPS which we are going to come out soon at the group level. So within PPFAS Alternate Asset Managers, yeah, before that, basically this slide needs no introduction from our end. Neil sir is the chairman and CEO of the entire group. Raju sir is the chief investment officer at PPFAS Mutual Fund, and he is also a director in the current in PPFAS Gift City, ensuring his involvement here. In terms of PPFAS timeline, so this company itself was formed in November 2024, and it received its FME retail license from IFSCA in 2025, in April 25. And this FME retail license basically allows us to launch the PMS as well as all categories of AIF as well as the retail funds. So currently we have a full-fledged team sitting out of GIFT City. You can see the 3 KMPs here at present, and beyond this, there is an operations team who handles all the uh, client onboarding as well as all the operations related stuff as well as compliance. Uh, Talking about what we intend to do from GIFT City, the PMS is already live. There is a retail active fund which is expected to come out, but that would be another 6 to 9 months before this retail active fund comes out. So it will be effectively in the next financial year only. At present, we don't have a lot of details available for the retail active fund. So questions on that we will be able to provide only limited insights on today's call. The passive funds, S&P 500 and Nasdaq 100, we have received approvals for both of these funds, and we are in advanced stages to launch this. So we will give some details around the timelines and everything for this, and along with all the product specific features. On the inbound side, that is for NRIs and foreign investors, we have Parag Parag India FlexiCap Fund, for which we have received all the approvals. Again, this is a feeder fund which would feed into the FlexiCap, Parag Parag FlexiCap Fund in India. We are also planning to come out with Parag Parag India Large Cap Fund, which will be feeding into the large cap Parag Parag Large Cap Fund, which is for which the NFO is opening next week on 19 January. Yeah. So with this, I'll like to hand over the call to Akshay to speak a bit about why global investing, and from then there we'll continue to products.
Thanks, Nirmal. So before going on to why global investing, let's discuss why what we intend to achieve through investing in a general sense. So we want a portfolio with good quality company, as in companies with good ROICs, good free cash flow generation capabilities, long-lasting competitive advantage, or good corporate governance. Then we want a portfolio which is diversified across different sectors to somewhat insulate us from the specific sectoral downturns. And we want to buy companies at the reasonable valuation to ensure decent returns. Now, global investing provides us with a larger pool of such companies, with bonus of basket of companies which are currently at the cutting edge of the technology. It further augments the risk reduction approach and help us to achieve the reasonable risk adjusted returns. So from an opportunity point of view, India of the total world market cap is less than 5%. So through this global investing, we tap into large pool of investable companies. So covering US, Europe, and developed Asia, we broadly covers the 75 to 80% of the pie. Now, cloud infrastructure, semiconductors, AI, innovator, pharma, all this are the trending sectors. Now, companies in these ecosystems are at the cutting edge of the technologies. Few companies in these ecosystems are so ahead that the next company in the line is at least like 5 to 10 years behind. So as an Indian, we are spending a lot of money in these companies or in these themes directly or indirectly. However, for investing, probably there is no such opportunity available, or at least the opportunity is delayed for long period of time. Secondly, as India's per capita income is increasing, people tends to consume more. Now, this incremental consumption is not only going into the FMCG, but also going into the premium products as well. As we have seen recently, people are buying more and more high-end cars than ever before. Similarly, this premiumization of consumption is also benefiting these foreign brands. For example, we might be buying electronics which are made in India, but the larger value accumulation happens at the brand level. Then we have long legacy companies like Hermes, which makes the luxury apparels and luxury accessories. Now the price of that one single item could be somewhere in the range of 8 to 10 lakhs. That is that premium or luxury kind of offerings this company gives. still this company is sustainably growing its revenues in the range of 7 to 12%. And of course, now this is some part of it is obviously coming from the emerging markets. Now, global investing actually provide us access to all these kind of companies out there. Now, in this larger pool, we can find lot many high ROICs and capital efficient businesses which are available at reasonable valuation. For example, if we compare US largest 500 companies versus India's largest 500 companies, of course, Indian companies would be growing much faster. But in terms of quality, if we take the median, let's say returns of tangible equity, return on tangible equity of US companies versus India, it is somewhat like 24% versus 17%. Whereas if we see the free cash flow generation capabilities of these companies, the free cash flow yield there is 3% versus 1.2% here. And all these companies are even sometimes available at reasonable valuations, maybe at discount of 10 to 20%. Also, along with that, we can also benefit from some valuation arbitrage. So here we are showing the valuations of foreign parent company and their listed subsidiary, Indian subsidiary. There is a huge gap. Now that is obviously because of high growth in India. However, sometimes there are good valuation arbitrages available, which are available to tap into. Lastly, diversifying the risk. We all know that as we include more and more stocks in our portfolio, we diversify it, risk actually comes down. But if it's just a domestic diversification, then we will still be exposed to country-specific risk. In last 10 years, we have seen a lot of negative events like GST rollouts, demonetizations, NBFC crisis, border tensions, etc. And that exposed us and that badly impacted the Indian markets, whereas the foreign markets were untouched. So as we include more and more global stocks, the country-specific risk actually gets eliminated or minimized. Now, while diversifying, it is also important that the markets are loosely correlated. Now, as per some of the industry standards, if the correlation between two markets is less than 0.7, then it is a fair diversification. So in this chart, we have plotted 3-year rolling correlations of a price change of NSE 500 versus MSCI World, and at least and only 20% of the times the correlation has been more than 0.7%. So we can say that India is kind of loosely correlated with the developed markets, and there is a good diversification benefit available there. So in this chart, what we are trying to say is, if we would have invested in NSE 500 in May 97, it would have given us a CAGR return of 13.7%. Now this is dollar returns, versus if we would have built a portfolio of NSE 500 and MSCI IMEI in the ratio of 60 to 40, the returns would have been 13%. Now the return impact here is just 70 bips. But if we see the benefit of diversification on the left-hand side, the volatility reduction was huge. It is close to 25%. Again, this chart also shows how these markets are loosely correlated and provides the diversification benefits. And lastly, of course, there is also an incidental benefit of foreign investments, which global investment, which is rupee depreciation. It has been close to like 3% over last 25 years. Now coming on to the products, we have PMS, which is already live. I'll just go through the nuances of how the team is built and how we use the how we have built our strategy around global investing. Then Nirmal will take through the features of the product. So as the PPFAS group has been doing the global diversification since very long period of time, the global investing strategy has built around the base of close to 500 companies ex-India. This has been built over last 10 years. We have a research team of more than 20 research analysts who are specific sector analysts, and they, along with India, covers the global stocks as well. So the ideas are shared across and also helps in the decision making. The investment process remains same as the value investing approach is embedded across all products in the group. As we discussed earlier, in global investing, there is a larger pool available for investment, and we get many options of good quality companies at reasonable valuation. We have built a model portfolio internally with combination of US, Europe, and developed Asia. The portfolio comprises of the companies with decent revenue diversification geographically, sustainable cash flow generation capabilities, strong competitive advantages, etc. And we have built the strategies bottom up and built up around an objective of partnering into growth of the company, and therefore initial intention is to hold security for at least 5 years, and therefore we expect very low churn there. As we intend to hold stock for 5 years, the entry point in the stock matters a lot, and therefore we not only take valuation calls at the model portfolio level, but at individual portfolio level also we take these valuations. We remain mindful of the valuations. In terms of asset allocation, at fully constructed portfolio level, will at least held 70% in equity. Now, depending on the market movements and valuations, we may hold some of the funds into cash. Now, this will be invested in the money market instruments. The maximum allocation in single security will not be more than 10%, whereas the maximum allocation in single sector will be up to 25% only. Now, when we are investing in the foreign geographies, the corporate governance, local law, financial reporting standards, and transparency, all these factors are really important to look into, and that's why we largely invest in the countries where we have decent comfort over all these aspects, and that's why our investment geography target is mostly US, Europe, and the developed Asia. I'll just hand over to Nirmal to take you through the products.
Yeah, so in terms of PMS, at present, the PMS is open to resident Indian individuals, and we keep getting a lot of questions around who can invest and how can the investments happen. So at present, resident Indian individuals who are majors, so minors are not allowed under this PMS, can invest. The money can come either from your domestic bank account, or if in certain clients cases, if they have already transferred money through LRS or something and have that money in a foreign bank account, we can accept that with additional disclosures, as well as if someone has built a foreign portfolio but now wants to transfer that completely to us, we can accept transfer of positions as well. So these are the three ways for clients to bring in money to meet the minimum commitment. Additionally, this PMS will also be opened up for NRIs soon. We have started accepting NRIs in a very small way with some test cases currently going live, but it will be opened up for the larger audience at large within a quarter or so. The base currency for everything in GIFT City remains US dollar. That is the case with this PMS as well. So there are two services. Discretionary is primarily what we intend to have for the clients, where we take all the calls regarding what to invest in and when to invest in, as well as we also provide the execution for the same. In the advisory side, we only provide advice on what a client should be investing in, and beyond that, whether the client accepts that advice or not is beyond the purview of advisory, and also the execution is on the responsibility of the client per se. There are no exit loads or entry loads at present. We have tied up with Interactive Brokers, so the entire platform runs on Interactive Brokers platform for where the client will also get a login account, login ID and password, where they can view their statements. They cannot trade per se, and we will be able to execute trades on their behalf. The minimum ticket size for resident for individuals at present is $75,000. Now this PMS cannot under LRS. Only individuals can transfer money in a PMS. For non-individuals, the mechanism to transfer money outside India is OPI, Overseas Portfolio Investment, which is allowed through GIFT City, but it is allowed only in pooled vehicles. And PMS is a separately managed vehicle. It is not a pooled vehicle. So non-individuals cannot invest in this PMS, at least for residents in this case. Non-resident, non-individuals can come in as and when they are opened up. Uh, the ticket size I have said minimum $75,000. This is true for discretionary. For advisory, typically a client would have already transferred large ticket size outside and built a portfolio. So the ticket size expectation there is $200,000 or for one account, or $500,000 across a family of accounts. The management fees is 1% or 2% plus GST, depending on the mechanism you are coming in, direct or through regular channels. And then there are some 10 to 20 basis points of expenses, which in the first year, which will be as per actuals. Second year onwards, it goes down negligible, less than 10 basis points. Yeah. So on the PMS taxation front, and we have received a lot of questions on this part again, so I'll spend some time here. There are 4 types of taxation that come into picture. The first one is there's a TCS when someone is transferring money through LRS. So if you're transferring more than 10 lakh rupees in a financial year, then there would be a 20% TCS applicable for investment purposes. The TCS rate changes for some other purposes as well. And so which effectively means that on a $75,000 ticket size, if someone is transferring this money, there would be an additional TCS impact of the tune of 12 and a half lakhs. The second one is capital gains. So as I explained that PMS has a structure where it is a separately managed account of sorts, where all the ownership of the beneficial ownership of the stocks remain in the name of the end client. So the end client is responsible for all the capital gains that accrue on all the buy sell transactions that we do at in the PMS. And for securities that we are selling within a period of less than 2 years, those will attract short-term capital gains, and the short-term capital gains tax rate will be as per the respective tax slab of the investor. So it is not 20%. If the investor is in a 15% tax bracket, it will attract 15% taxes. If the investor is in a 40% tax bracket, then it will attract 40% short-term taxes. If our holding is more than 2 years in that particular security, then the long-term capital gain tax of 12.5% plus whatever surcharges and cess that will be applicable. For secondly, the taxes on dividend income. So there is a withholding tax that comes into picture in multiple geographies. In US primarily, there's a 25% withholding tax for Indians, and this rate changes for various nationalities. It goes from 15% to 30% depending on what PTA is there between US and those specific countries. So for Indians, it is 25% withheld in US, and if your tax rates in India, if your tax slab in India is more than 25%, then you would be required to pay the incremental taxes in India. If it is less than 25%, then you don't get back anything here, to be very clear. And to claim these taxes, there is a Form 67 which is required to be filed by investor before filing income tax returns. Finally, there is an inheritance tax which comes into picture in the US. If your US situated assets are more than $60,000 in total, then as a non-resident alien NRA in US, you would be charged an inheritance tax if something happens to you. And this tax rate is a slab rate starting from 18% and going all the way up to 40% on total assets of more than $1 million. So we generally indicate clients to open open joint accounts for various benefits and the PMS. So on the portfolio, so we have given out the snapshots of how the portfolio has performed. The PMS was launched only in the month of August, and the investments effectively started happening in the month of September. So it's been 4 months only. And if you look at the S&P 500 performance over 4 months of 6.19%, probably that is also a bit on the higher side. But given that we have been receiving money at various points in time and those monies are not invested right away, uh, there's decent amount of cash holding, which you can see 40% cash holding at present versus around 23.5% in the model portfolio. And because of this, there's some amount of underperformance there versus the index. These are the top 10 holdings and the sector allocation. I think we can. So coming to the outbound funds, so S&P 500 and Nasdaq 100. So there are quite a few. Both of these funds are structured as retail funds from Gift City. So the minimum ticket size would be $5,000 and all. There are a few benefits of why one should look at this funds instead of investing through an Indian mutual fund or going directly. So versus an Indian mutual fund, at present the window for Indian mutual funds to invest outside of India, the overall size limit of $7 billion, which was given by RBI, that limit was hit in February 2022. So after that, mutual funds have not been able to remit money outside of India, and so even in the cases where funds are accepting money, that is either against redemptions that they are getting, or in cases where there are ETFs. Now ETFs are slightly different in that they are tradable, and so if there is good amount of demand, or then the prices would stray far from the underlying index prices, and if there is good amount of selling pressure that comes in, then the prices would go down despite even if the index is not actually performing badly. So there's a huge tracking error that comes in that. So then the other way of investing for investors is to either go direct or look at this FOF, this fund of funds. So one is, if someone is investing directly into US, then there is an inheritance tax implication, as we discussed in the case of PMS as well. For Gift City fund, there is no inheritance tax implication because your money is coming to Gift City. Secondly, there is ease of tax compliance at two levels. One is the tax is paid by the fund, and so whatever the investors receive will be net of tax. Secondly, uh, it may not the Gift City investments, since from an income tax perspective, Gift City is already a part of India. Gift City investments may not be required to be reported under Schedule FE. Now there are multiple opinions on this, and there would be some clarity expected later on. Thirdly, if you look at OPI routes, the one which I discussed earlier, OPI is allowed only through Gift City and not for any other geographies. So if if a family office is looking at larger ticket sizes, then this would be a mechanism to come in. Finally, at a fund level, given the volumes that we expect, we are able to optimize cost at various levels for the investors. So be it the exchange rates that investors will get, or uh, the broking expense and everything that we would incur at the fund level, all of those would be quite low, and that ultimately benefits the investors in terms of lower tracking errors. And finally, there is an additional layer of compliance that comes in because we are IFSCA registered, and we have strong governance frameworks of our own. So net DIY versus FO investing in this fund of funds, it is ease of access plus certain other benefits in terms of actual returns as well that one can expect. Going to the fund facts of S&P 500 and Nasdaq 100, so for S&P 500, the benchmark will be S&P 500 net total return index. The face value is $100. The NAV would be available on a daily basis, and there would be two NAVs that would be available: long-term post-tax NAV and short-term post-tax NAV. So, as I said in the previous slide, that taxes are to be paid at the fund level in the case of a retail fund. So this is slightly different. Sorry, this is slightly different from a mutual fund, where in the mutual fund, once the client redeems money, that is when they are liable to pay taxes. At the retail fund level, whenever we are selling something, we would be required to pay taxes on that. And basis the holding period of less than 2 years or more than 2 years, the tax rate for short term would be 42.75%, the maximum marginal rate, and for long term it will be 12.5% plus surcharges plus cess, which would amount to around 14.95%. So if an investor, in the case of this fund of funds, since we would be investing in UCITS, and the only time we will redeem is when the investor is redeeming. If the investor's holding period is less than 2 years, then we will then we will give the proceeds at short-term post-tax NAV, which will be computed considering the higher tax rate. And if the investor's holding period is more than 2 years, then the redemptions will happen at the long-term post-tax NAV. The subscriptions in all the cases will be at long-term post-tax NAVs only. So the long-term post-tax NAV in this case can be thought of effectively as the master NAV, which can be used for all subscriptions as well as redemptions beyond 2 years. There's no lock-in and there's no exit load applicable. There is direct as well as regular plan. In direct scheme, the expense ratio is 30 basis points for the fund, and in regular it is 60 basis points. Now you would also see the maximum TER including investee funds. So the underlying funds also have their own expense ratios. In the case of S&P 500 underlying ETFs or UCITS, the expense ratios tend to be in the 5 to 10 basis points bracket for the funds that we are considering. And so we have kept a maximum ceiling of 10 basis points over and above our expense ratio there. So the details for Nasdaq 100 remain similar to what it is for S&P 500. The only change here is the maximum expense ratio, maximum TER, including the investee funds, is 0.55% and 0.85%. That is because the underlying funds for Nasdaq 100 are or ETFs for Nasdaq 100 are more expensive, I think. And one more thing to focus on is that these are TERs, the total expense ratios, and there would be nothing beyond this which will be charged, unlike the PMS where there is some operating expense which comes in. So from in terms of process of onboarding and the tentative dates for the same, there will be three processes that we will have for onboarding. One will be a physical form. Second one will be a assisted flow, which would be primarily for the distributors to onboard their clients and all. And then third one will be a DIY process, a complete digital onboarding process for the end investors themselves. So in terms of physical form and assisted flow for distributors, we expect that to go live in these are tentative dates, all of them, in the next week starting 19th January for individuals. For non-individuals, the physical form will come a week after that, and the assisted flow will come in the first week of February. And the DIY flow is expected in the month of February near to the NFO dates. The NFO is expected to start on 22nd February. We'll give out a complete timeline as well as all the flow charts regarding the process and everything on the website as and when starting next week. Now coming to the India FlexiCap Fund. So the India FlexiCap Fund is meant only for NRIs and foreign individuals, FIS. Resident Indians will not be able to invest in this. The underlying fund remains the FlexiCap Fund in India. The face value is $100 again. The minimum rest of the things remain similar to FlexiCap in terms that there's no lock-in, but there will be an exit load applicable similar to what the underlying fund charges of 2% for the first 365 days and 1% for the next 365 days after that. The minimum investment ticket size here is $10,000 and not 5,000. And minimum top up accordingly is $1,000. The expense ratio for direct is 30 basis points at the fund level, and including the underlying fund, it will be 0.93%. For regular, it is 1 percentage point of expense ratio and 1.63% including the underlying fund. So this is just
Summary.
This is just a historical data chart of how the India FlexiCap Fund would have performed had it been launched simultaneously along with the FlexiCap Fund. So this excludes the 30 basis points of additional expenses that we are charging, and then all the numbers are in dollars. So the scheme would have returned 14.9% versus 10.9% for Nifty 500 and 9.7% for Nifty since inception. Yeah. So coming to a summary of all the things that we have in pipeline, the inbound funds, both of them, one we would tentatively launch in the month of March. The second one would come in later. That is, and from the perspective that the underlying fund that we are investing in is an active fund. The outbound PMS is an active product again, where we bring in our research capabilities to the fore. The passive funds are excess products and meant because the easier way for Indian investors to invest directly in similar mutual funds has been now has been stopped or is not meaningful enough for them. There will be no active component, there will be no cash calls in this. So whatever we are receiving, we will be looking to invest the entire amount on the same day, excluding the expenses part of it. And then there is a active fund which is in pipeline, which we will come back once we have solid dates on the same. If you are interested in any of this funds and you want us to add you to your to the database per se, then there's a get in touch option on our website gift.ppfas.com. If you're not already registered there, you can register your interest there, and we will put you in our relevant databases for and keep you updated on as and when the fund launches and everything are happening. Secondly, you can also reach out to us on customer service at PPFS, customer service _ gift at ppfs.com. Thanks.
Yeah, so thanks.
I think Shailendra, we can now move to questions.
Thank you, team, for giving an overview. So we'll begin with the questions that we have received. Nirmal, the first question is on allocation for you. An Indian investor, what is the percentage of portfolio should we allocate to the global investing?
We have been generally saying that for an Indian investor, the global allocation, considering a generic allocation pattern, it should be 25 to 30% of the overall assets should be invested outside of India to benefit from global diversification, from emerging themes and everything that we discussed in. So in the past, if you look at FlexiCap itself, it used to provide that exposure by having 25-30% of its assets outside. Now it has become a DIY for the investors that they will have to invest separately to get that 25-30% kind of global exposure. Obviously, in the case of specific individuals where there are different goals that they have in terms of maybe children's education, or they want to settle outside India or something, then in such cases the allocation can be higher than this number.
Okay, thanks, Nirmal. There is a follow-up question on the similar lines. As a first-time investor in US dedicated funds, in what ratio should he split in S&P 500 and Nasdaq 100?
So one thing that we didn't speak about for the S&P 500 and Nasdaq 100 is the kind of indexes that they are considering. They are widely known, but Nasdaq 100 is a more technology focused investor. It is more it has obviously S&P 500 has 500 stocks while Nasdaq 100 has 100, and the concentration of the stocks in Nasdaq 100 is definitely higher. So it would be preferable for a investor to have higher proportion of their overall US allocation or global allocation in S&P 500 versus Nasdaq 100. Nasdaq 100 can be 20 to 40% of your exposure, considering various how optimistic you are on the US tech cycle. And for investors who are very knowledgeable about the US tech and have strong views on the same, then they can take higher exposures on Nasdaq 100%.
Thank you, Nirmal. Akshay, you have already explained that the limit for the Indian mutual fund industry, the $7 billion, that is already breached. So there is a question that whether the Flexi Cap fund will invest in Gift City fund or Nasdaq passive fund.
So first of all, I think we don't have any intentions as a FlexiCap fund will not have any intentions to invest in these passive funds. And secondly, mutual funds further cannot even remit money for investment outside of India. And so therefore that is also applicable for the Gift City funds.
Okay. Nirmal, there is a question on LRS transfers. Is it allowed to transfer funds from a US broker account to your Gift City account?
So basically, in the context of a PMS, whether US broker accounts to our Gift City account, there can be transfer of securities that can happen. We also said that we can take money from a foreign bank account into the Gift City account for the PMS. However, similar things for outbound fund in terms of transfer of securities or transfer from a broker account to our outbound fund account, that won't be possible.
Okay. The next question is also in the context of PMS and related to the taxation. Regarding PMS, what happens if a resident account holder becomes NRI or the other way around? A NRI becomes a resident India. Then how the taxation plays?
So since taxation for the PMS is at the individual level, if a resident account holder, let's say, becomes a NRI, then the country that they are shifting to, that country's at present for a resident Indian, the Indian capital gains taxes will apply. When they shift to some other country, and the capital gains norms of those countries will apply to those investors. Similarly, for NRIs converting from non-resident to resident Indians, there will be no, as such, we won't require someone to withdraw funds or anything from the PMS just because they are converting, as in their status is changing from NRI to RI or RI to NRI.
Okay, thanks. Akshay, this is for you again in the context of PMS. As a resident investor, which global markets you cater to and why seeing next 5 years view? Is your country-wise allocation will change dynamically based on those yearly dynamics in each country? Will you invest in respective country stocks and some general ETFs? Why you think those overseas market likely to do better compared to India?
Yeah. So first of all, we are not restricting investments to any particular geographies, or we don't have specific allocations to all the countries. Our process is completely a bottom-up approach where we don't take the macro call, we don't take the macro calls, we rather take the company-specific calls. Uh, Secondly, why to invest in overseas markets? We are not targeting to achieve supernormal returns. Rather, it's about earning a risk-adjusted returns there. I think.
Yeah, so one more thing that we would want to add is the way we are looking at building this portfolio in itself. We are looking at companies which are well diversified in terms of their revenue from various geographies, and not looking at companies which are very geographic specific or economy specific niche segments on or sectors. Now, in when you are looking at that also helps from a research point of view, that we don't have to be present on ground in a specific country, or to see what is happening with such uh, companies over there, but also that takes out the country specific risk that one is exposed to. And so basically we don't then need to take a call on whether uh, one country's economy is going to do well or not in the next couple of years, 5 years, whatever. As long as the companies that we are betting on is doing well, we'll be able to invest on in them and make meaningful returns for the investors.
Thank you, Nirmal. Moving towards the questions related to outbound funds. So, Nirmal, this is for you. When are we going to launch international active funds similar to some peers? Fund which can invest in companies across geographies. Why have we chosen FOF over this option?
I think the first part of the question we answered during the presentation itself, that it'll take another 6 to 9 months uh, to launch that. But in terms of why have we chosen to launch FOF versus active funds first? See, the tax structure for gift city funds is such, it is not similar to mutual funds. It is similar to Cat 3 AIFs in India, which means that every stock that we buy or sell, on every sell transaction, whatever the capital gains are, we have to pay taxes on that at the fund level, and then reinvest the proceeds. Now that becomes a very tax inefficient mechanism of compounding money over a very long period of time if one were to do this investing directly. So we thought it'll be good to test waters first with an FOF, and then later on basis we can look to launch a active fund which will be in a more tax efficient vehicle, rather than uh, going directly and launching an active fund first.
Okay, got it. Let's talk about holdings. For the PPFS gift S&P 500 FOF, would you allow multiple holders, such as primary, secondary, and tertiary, like mutual fund in either or survivor mode?
Yeah, so that is allowed. So holdings, like there can be up to three holders, and minor investing, while it is not allowed in the PMS, it is allowed for outbound funds, along with a guardian and everything, the way it is for mutual funds in India.
Okay. Per se, say I'm an Indian resident. Can I open a forex account in gift and directly invest to PPFS funds from it, or it has to be Indian currency account?
I think that's a very good question in terms whether one should open a forex gift city account or not. So one is for investment in this outbound funds. You don't need to open a gift city account or a foreign currency account per se. But if in future there when you want to get the proceeds back, and you don't want to get those proceeds back in India, you want that money in dollars, then it would be preferable for someone to have a dollar denominated account in Gift City where the proceeds can come back. Secondly, as and when there is an SIP option or something available, there is a higher probability that such SIP options would first open up for Gift City bank accounts rather than domestic bank accounts. So right now, while investing, it is not required for anyone to open a GIFT City account. Later on, probably it will be beneficial for anyone who's looking to keep that money in dollars to open one.
Okay. So there are multiple questions which is related to the LRS limit and the transfers. I'll go one by one. So the next in line is that I have some FCNR or RFC. Can I transfer for investment and how? What are the TCS and other compliances on regular basis? How are redemptions dealt with?
So one is for the common knowledge, FCNR account is available only to non-residents, while resident foreign currency RFC account is available only to resident Indians who have converted from NRI status to residents, and their NRE account gets converted to RFC. Now, since in the outbound funds context, we are not allowing non-resident Indians to invest in this fund. You cannot have a FCNR account which will invest money in this funds. RFC accounts will be allowed if someone has become a resident Indian recently and has converted to RFC account. Those will be allowed for outbound funds. The FCNR account, someone can use that for inbound fund investing if they are interested in investing in the India Flexi Cap or the India Large Cap as and when it comes.
Okay, thanks. This question is slightly long and more of operational issues I can figure out. So he's asking that employees who work with MNCs have RSUs allotted, and I have done diversification using interactive brokers and Charles Schwab into various funds. To enable investing in PPFAS gift funds, I want to liquidate that and send funds to you. However, doing that using mainland bank will involve unnecessary reconversion related loss. What is the effective way for this?
The most effective way for this is to set up a bank account in GIFT City or elsewhere where you can transfer those funds and then invest in this in the outbound funds. In the PMS, it is possible for us to take direct transfer of stocks as we discussed earlier, but for this outbound funds, it will have to be some bank account owned by the investor in his own name from which the funds are coming in.
Okay. So the similar question, the next one is that I am in India now, tax resident in India after staying abroad for several years. Can I invest in the schemes from the funds lying in my Singapore bank account?
Yeah, so it is possible for investors to invest in the outbound schemes using foreign bank accounts. We would require additional disclosures from them regarding the source of funds in those cases, but that is allowed.
Okay. The next is that will you allow a large USD transfer for resident Indians from their RFC accounts for then deploying the amount say over 6 to 12 months to the S&P 500 FOF instead of a smaller manual top-ups?
So this cannot be done in a passive fund construct. So whatever amount is being transferred to us, we will have to, in order to ensure that there is minimum losses in terms of or minimum errors, tracking errors and everything, we'll have to ensure that the money gets invested on the same day or the next business day per se. So it won't be possible for us to deploy that money gradually. And anyways, this is a retail fund construct similar to a mutual fund. So a client specific requirement of gradual deployment cannot be taken into consideration. The client will at their end have to transfer money in tranches if they want the investments to happen over a longer period of time.
Thank you. There are 3 more questions related to LRS and transfers. After investment, whether US S&P 500 ETF holdings will be transferable to a family member at a later stage.
So there are two parts to this. One is transferring this holdings to family members on the passing away of investor, and transferring to family members as a gift at a later stage. Now, in the case of passing away, that is possible, but when if you want to transfer this holdings to your family members as gift, then the relevant FEMA regulations come into picture. If the FEMA regulations at that point of time allow such gifting, then we will be able to process that, else not.
Okay. And can investor transfer funds from my overseas broker directly to this fund for acquisition of units?
Again, I think we have taken this question earlier as well. So overseas broker directly to the fund is not possible. There it has to come from a banking account which is in the name of the investors.
Okay. And whether TDS will be deducted on 20 lakh lump sum investment in Gift City Fund, as effectively my money will buy dollar for investment.
Yeah, so this TDS aspect again we have included in the PMS discussion, but TDS for investments in Gift City are driven by LRS regulations. So anyone who is doing a LRS transfer of more than 10 lakhs
TCS.
will be so one is it is TCS, sorry, and not TDS per se. The difference is that TCS is collected over and above your invested amount. So if you are transferring 20 lakh, looking to transfer 20 lakh rupees equivalent dollar amounts to for this fund, and assuming this is the only LRS that you are doing in the year, the first 10 lakhs will be there will be no TCS, but for the next 10 lakhs there will be 20% TCS, which is 2 lakhs. So your bank account needs to have 22 lakhs, of which 20 lakhs comes to us, and 2 lakhs get deposited against your PAN card, and which can be then used for offsetting advanced tax liabilities and all those things.
Okay, thank you, Nirmal. Before I move to the next question related to product, can you put up your video? I mean, suddenly it has disappeared. Just check the setting, please.
Yeah.
Yeah, now you're visible. Yeah, it is. So the next question is related to product. It's a slightly off point, but I want to know the comparison between investing in triple Q ETF directly through some platform or investing through Parag Parikh IFSC Nasdaq 100 FOF, which is the better way for a long-term perspective.
So we discussed this question in slight detail when we were going through that presentation. Again, doing a DIY versus investing in this FOF. So a DIY investor investing in a QQQ ETF, which is listed in US, exposes himself to inheritance taxes, which a Gift City investor doesn't. Secondly, in terms of tax filing, and there would be Schedule FA compliance and all which the investor would have to handle at their own levels, which is simplified with the Gift City fund per se. So if you are looking at investing similar to the way you do in a mutual fund, where you invest and the fund manager takes care of all the complexities, then ideally a fund of fund is the way to go. If you are a DIY investor, then there would be some interim benefit of doing it through the platforms, but over a longer period of time, we understand that even the DIY investors would be better off investing in funds rather than through platforms. We have done some calculations on this at our end to come to this conclusion.
Thanks. Can a seafarer invest in outbound funds? LRS applicable? And what happens after they settle in India?
So this is an important question. So LRS, one is the first thing is in outbound funds, non-resident Indians are not allowed to invest. The reason for that is specific fund level taxation that we talked about. So a non-resident Indian investing in a outbound fund would be exposed to, even if they are long-term investors, they would be exposed to 15%, 14.95% long-term capital gains taxes, which means that if their money has doubled over a period of 6, 7, 8 years, whatever period, uh, they would only receive 85% of that and not 100%. And this taxes that are deducted at the fund level may or may not shield them from paying taxes in their home jurisdiction. So basically, there might be instances of double taxation on the non-resident Indians who are tax residents of other geographies. Now, for seafarers specifically, they are classified as non-resident Indians, but they are not tax residents of other geographies. So such double taxation impact may not come. They will still be exposed to the adverse effects of being exposed to Indian taxation there. But if a seafarer ultimately intends to settle in India, then it might be easier for them to come and invest in this outbound funds. Secondly, most seafarers receive their salaries in dollars in accounts outside of India. So if they are transferring from those accounts, then LRS will not be applicable for them. If they are transferring from an Indian NRO account or some account, then the respective FEMA related cappings would apply for them.
Okay, thanks. The next question is on SIP. Is there any automated SIP mode investment solution PPFS can give to retail customers for these outbound funds?
So at present, there's no SIP mechanism, but we will test out certain things, and over the next few quarters, we may come out with SIPs for the outbound funds.
Okay. Though you have broadly covered the taxation part in your presentation, there are multiple questions related to tax. We'll take one by one. My current tax status is NRI. If I invest in any of your outbound schemes now, and in a couple of years when I return back to India and become a normal resident, can I continue to have the investment in the outbound schemes?
So as I just discussed, NRIs will not be able to invest in this scheme in the outbound funds per se. So this question will not be relevant that way. Once
Okay.
they become normal resident Indian investors, then they can invest in this funds.
Got it. And how gift funds are taxed and how to show in IT returns?
We have covered this on the gift funds being taxed at the fund level and the tax rates and everything. In the IT returns, this would typically be shown as exempt income for the capital gains will be shown as exempt income for the investor, and this is covered under certain general principles of the income tax act.
Okay. Nirmal, in domestic mutual funds, selling of individual stocks does not attract STCG or LTCG, as mutual funds are registered under Trust Act. Will the same privileges allowed to give PPFS fund?
No. So again, we discussed this. Taxation for retail funds are similar to the taxation that is applicable to Cat 3 AIFs in India and not mutual funds in India so far. So each transaction that we do will be exposed to STCG or LTCG.
Okay. The overseas securities, wherever they are listed, will be subject to tax as per their jurisdiction. Will the fund take care of those taxes? And will the foreign tax credit certificate be issued to investors? Foreign tax can be as high as 30%. In such a case, investor return gets significantly impacted, especially if they cannot claim tax credit. Kindly help on this. If it's a gray area, have you taken any opinion on the same? which we can share with the investor?
So see, one is overseas securities are not taxed in the geographies where they are listed, except for the withholding tax that is applicable. The taxes, capital gains taxes are payable according to Indian regulations only, and they would be payable in the case of outbound fund. We would be investing in accumulating usage, so there would be no dividends per se, and uh, relevant taxes will not apply. And whatever transactions happen at the fund level, those would be only on account of clients withdrawing money. So those respective taxes, depending on the holding period, would apply in India only. So, and secondly, there won't be any certificates or anything given to the client per se here in a retail fund construct for foreign tax credit, because there's as such there's nothing in terms of foreign tax credit.
Okay. In the presentation, you have broadly talked about the maximum TR. You have covered that point. Here is the question related to that. Please share the exact list of funds that the retail funds will be investing into so that we can know exact TR and trust your investment based on your selection of UCITS.
I think we would not specifically want to name what UCIT we want to invest in, because that limits our option in terms of having said one UCIT. If we find something else to be better, uh, we would have to go back and change that. So instead of that, we have done our analysis on the entire bucket of ETFs and UCITS both, and basis that we have done some shortlist. The maximum TER that is given out is basis that shortlist only, and there's this entire list is for UCITS and all is easily available. So one can look at that basis that we will select the UCITS on the basis of liquidity and tracking error and all of those aspects. So I think for analysis purpose, one needs to use the maximum TER that is provided.
Thank you. The next question is on tracking error. What are the expected return with respect to Nasdaq 100 index? Is it same as index or there will be some tracking error? If yes, how much?
So this is again a very important question in terms of how to track these funds. One, there would be the expected returns will be in line with the Nasdaq 100 index, except for some tracking error. The tracking error can will be because of the fund expenses as well as whatever other reasons it can be. But when someone looks at the post-tax NAVs that we publish, now remember that if the index has gone up by, and I am talking specifically about the long-term post-tax NAV, which will be used for subscription and redemption here. If the index has gone up by 20%, the fund will, let's say in the absence of any other tracking error, the fund will also go up by 20%. But then there would be 14.95% capital gains taxes that would accrue on that unrealized gains, which would mean that you would see only the fund going up only by 17%. Now that can result in very different tracking errors that you would see. But if at a post-tax level for the investor, the returns would be similar to what they would similar to or better than what they would otherwise achieve by investing directly in Nasdaq 100 index.
Thank you, Nirmal. So there are two more questions related to outbound funds, and then we'll move to the inbound. The question is, for Gift City investment ticket size is very high. So is there any method of transferring that initial investment of 5,000 USD equivalent from PPFAS liquid fund, which we accumulate by an SIP?
So I think this question will again probably come up in the question queue or for inbound fund as well. So as we showed in the second or third slide itself, that these are two different entities, and the uh, funds are under completely different trust and everything. There is no mechanism for any transfer of securities or transfer systematic transfer plans or anything from PPFAS mutual fund to PPFAS gift city funds. The money that can come to gift city fund can only come through LRS, or if a investor already has money outside India, that can be invested. So investors can at their level start putting in money in PPFS liquid funds to accumulate that $5,000. But ultimately, when they need to invest, they'll have to redeem and transfer through LRS.
Okay. There is one more question. It's an interesting one. Will existing Parag Parikh customer get an email on fund details with inception? Is it the same as Nasdaq index fund?
So existing Parag Parikh funds customers will not get a mail on the fund details, inceptions and all, because there are very strict policies around sharing of data and everything. And that is where I said that anyone who is interested should put in a request through the get in touch option on our website, so that you get added to our uh, uh, list, and we will inform you as and when you come in. Is it the same as Nasdaq 100 index fund? Yeah, effectively this the PPINDX, the Nasdaq 100 fund is similar, same as the Nasdaq 100 index fund that you would see from some mutual funds in India, as well as from multiple other uh, global fund houses and all outside of India.
Thank you, Nirmal. So again, there are a few questions on LRS transfer, but this is in context of inbound fund. So the question will look very similar, but that is for inbound. I have some FCNR or RFC. Can I transfer for investment? How? What are the TCS and other compliances on regular basis? How are redemptions dealt with?
Yeah, so since this was the similar question for outbound there itself, I said that for FCNR accounts, these are non-resident Indians only that can invest in inbound fund. So they can invest only through FCNR account and not RFC accounts. And uh, basically investing through FCNR account to the whatever the policy is around TCS and all at that particular point of time would apply. At present, I think there is no TCS applicable for FCNR or NRE transfers.
Okay, get it. Would it be possible to move PPFAS Flexi Fund units from normal mutual fund to Gift City without paying taxes? In bracket, as I'm not actually withdrawing. So that's the indication questioner has asked.
So from the income tax point of view, you are withdrawing and then reinvesting. So there is no mechanism to move for NRIs to move their PPFS FlexiCap holdings to Gift City without paying taxes. So that one-time tax impact will come in, and investors can at their level then decide whether they have a genuine case of shifting investments from mutual fund to uh, the Gift City fund at present, or they would be better off keeping those investments in Gift City, in the mutual fund itself. Now, and this answer would vary for each and every investor depending on what were their sources of funds and everything. Uh, yeah, invest in an inbound fund. HUF as a matter of fact, no resident Indian entity can invest in the inbound fund per se, and HUFs are a concept that are recognized only in India. So there may not be a HUF which is outside of India per se.
Okay, the next question is on rupee depreciation. Are investment in FlexiCap inbound converted from dollar to rupee? Redemptions in dollar to for USA based NRI, are the investment into inbound FlexiCap subject to inheritance tax or estate tax in USA? Third, does the inbound flexi cap protect against rupee depreciation?
So I'll take the third question first. So inbound FlexiCap doesn't protect against rupee depreciation because there is no active hedging or anything that we are doing in this fund. But the it'll be easy for a client to redeem because they'll have access to dollar anyways, and the redemptions and everything. There's no repatriation required per as in there is no restriction on repatriation or that is there in the inbound fund. On the first two questions of whether the investments are converted from dollars to rupees. So the way this mechanism works is investments in the India FlexiCap fund, that is the GIFT City based feeders, are accepted in dollars. When the money has to move to India and get invested in the FlexiCap fund accepts money only in rupees. So it has to get converted at that point from dollars to rupees. Redemptions will be in dollars only, as I said. And for US based investors, now US based investors as such, at least right now, US and Canada investors will not be allowed to invest in the inbound fund per se.
Okay, thank you, Nirmal. My current tax status is NRI. If I invest in any of your inbound schemes now, and in a couple of years when I return back to India and become a normal resident, can I continue to have the investment in the inbound? So the similar question was asked in outbound. So in
Yeah.
case of inbound, how will it work?
So this is very important from an inbound perspective. So when a non-resident Indian gets converted, there's a change in status from non-resident to resident. They have to compulsorily inform us, which they will anyways have to inform in even in the case of PMS and all. But in this case, resident Indians are completely not allowed to invest in inbound funds through GIFT City because that amounts to round tripping of funds. So we will have to compulsorily redeem those investments and give it back to the investor uh, in their designated bank accounts.
Okay. The next is what's the onboarding procedure KYC for NRI clients? Will there be a digital paperless process as well?
So the onboarding procedure for NRI clients, initially it will be a paper-based process, but later on we expect it to be. We also expect to come out with a digital process for the same. There would be a few additional things involved in terms of NRI client onboarding, like there would be a compulsory OSV, original seen and verified of the documents, or they would have to notarize their documents while submitting it to GIFT City. Otherwise, the process will remain similar to what we had earlier spoken of for the outbound piece.
Okay, thank you. In the beginning only you have explained the registration process for the MFD. So I'll move to the next question. Is there any app that you will be launching or is there any existing one that we can use to track our investment? Akshay?
Yeah, so PPFAS gift will have its own portal accessible from the website. So investor participating in different products will be able to see all their products listed in that portal itself, and will be able to download statements and all on that portal.
Okay, and the last one from the curated questions list. For Nirmal, I'm a UK citizen and I have funds in my NRO accounts in rupees in India. Can I invest from that?
This is again this since it is not clear where the investment is intended. For NRO account in India, if the client is looking to invest in our inbound fund, they can do so. It will involve conversion of rupees to dollars and then again back to rupees when we invest in the FlexiCap. But that is possible. And secondly, if the client intends to invest in the PMS, that would also be possible from the NRO account. Investing in outbound products is anyways not allowed.
Okay, thank you. So that brings us to the end of today's conference call. I think we have broadly covered everything. On behalf of PPFAS Alternate Asset Managers IFSC Private Limited, I would like to thank Mr. Nirmal Bari, Mr. Akshay Falgunia, and Mr. Purvesh Pandit for sharing their insights, and thank you for joining us and participating actively. If you have any further queries or require additional information, please feel free to reach out to us separately. Request you to follow us on different social media platforms. Our handle is PPFS Gift. Thank you once again for your time and engagement, and have a great day ahead. Thank you everyone for joining in. Thank you so much.
Thanks everyone.
Thank you.
Thanks a lot.